Hola a todos. Vamos a empezar ya porque...
Well, hello everyone. We're going to start now because although some people are not here yet because of the traffic jams, streaming has been developed so much that when you're used to streaming at home, you should be on time so that it doesn't seem that you're all alone left in front of your screen with nobody paying attention to you. So we're going to try and start on time. Next. No, it's not working. Let's see. Oh, there it is. Okay. So this is an outline of what we're going to be saying. These are the key figures and performance. We're going to talk about mainly two things. Inflation, obviously. We've talked about that for a very long time, but we are going to keep on talking about it. And even more rightly so, we're going to talk about everything about our portfolio, but we're also going to review energy, because 45% of our portfolio is in energy and mainly fossil fuels such as oil and gas. So we're going to talk about Santa Comba and then we'll conclude. I'm going to do the first part and then energy is going to be done by Vicente Martin and Juan Huerta de Soto, who has COVID, so he'll be doing it from home. So here we have Vicente Martin, Carmen Perez-Bagena, Nache Begine, and Juan Cantus. And I'm afraid one of our colleagues has been for 5 weeks in Shanghai and he could not make it today. And maybe next year what we could is have him connect via Zoom with us. So let's begin. We still have the same key figures we had yesterday. We had last year. We have 10 plus 3 plus 2. You know, we have EPSVs, PPIs and PPs and IICs. We have 1.8 billion being managed. We have seen a growth of 18% in the last few months, and everything seems to be working well. These first 4 months of the year, we have seen how things have unfolded. That's how things go. So we have our net inflows when the funds go up. It's also true that the reality in the bad moments we have been dealing with this last few years, we usually had an inflow behavior in the worst moments that were quite surprising, especially in the months of the pandemic during March, April, May 2020. But the reality is that, well, the inflows have been taking place when the funds had profitability and were recovering from the worst time, and we have 27,000 investors. It's been quite stable during the last 2 years. And now with regards to current affairs, well, we've launched Class B, 1.25% for those investors who have been with us for over 5 years. We will launch series Class A in 2 years' time for those who have been with us for 7 years, and it will be a 1%. And it was in line with what we had promised. You know, people who trust in us and who have decided to bear with us during very, very hard times. And many of you have been working with us for a very long time. So we needed to show some consideration and make things attractive for you. We have our new offices and it's in line with what we know. I mean, we have less income, so we needed to reduce our costs. So we have gone to a smaller office building, which is smaller, but not many clients visit us. So actually the office is just our work center with not much activity, not much commercial activity, although the offices are quite nice. So you're all invited to come and see us, obviously, if you wish to do so. And the CCAV has been adapted to the legislation, and we have over 100 investors, well, many more. We go above the minimums that the new law requires. Our objective would be to reach 500 participants. It would be a CCAV that could be that of the level of a fund and would allow for transfers. So that's what we're heading towards, and we're maintaining it. And some of our clients, some of our investors think that it is attractive for some personal reasons. So that's what the CCAV is offering. And We are going to launch a new platform. We don't want to really set a date, but it will be before summer. Probably it will be before summer. And we'll ask you to be understanding, because if we launch a new platform, you will see that there might be some weird situations. And the new platform will allow for digital registration, 100% digital registration, so that payment can be done. So everything will be much simpler. We will have a payment gateway for contributors, and it will have many functionalities that nobody has in the market, I've been told, and it will be much better than the ones that we currently have. So we have for some time been working on it. It has been delayed, obviously, like any technological development, but it will happen momentarily. We hope to have it before summer, and we will all be able to really enjoy from using that platform. So those are the current affairs in Cobas. That's for Cobas asset management. Now, with regards to profitability and performance, it's actually been better than the last few years. Our performance last year, when compared to the market, has been better. So the same thing can be said up at the beginning of this year. We've always said that at certain times we have had negative results, but we could have positive results at a bad time with a bad market. And this year we have actually proven that that is the case, that you can have good results when the market is not behaving as it should. And then we will explain why that is the case and what we may expect from the future. And despite all of this, we are still lagging behind. We're behind our index references in Spain and outside of Spain. We hope that will change very soon. And before we talk about the funds, let's talk inflation, because we believe that many people are really interested in what it is that is going on and what we can expect from the situation. We have been talking about this topic for a very long time. Everyone knows that inflation is the most dramatic danger that we investors who save can face. 800 billion that we have in current accounts that we have been mentioning during the last 5 years are worth 6, 7, 8% less than they were worth last year. And the sadness in all these things is that people who are saving don't really give it importance. They don't give it the importance that they should. They will find out sooner than later. They would rather have money in their mattress, but that is losing value on a monthly basis. So inflation is damaging our savings without us even realizing it. So inflation came, it had to come, and it came. And here we have what happens with interest rates, both in the US and the Federal Reserve, as well as the European Central Bank. We are talking about a situation where since 2010-28, our rates have been non-existent. We're not going to repeat it because we all know the situation, but that is the reality. That's one of the fundamental causes that goes hand in hand with the next cause, which is that of the increase of the balance sheets of the central banks. The developed countries have this modern monetary policy and theory that is, they call it modern, but it's actually older than the Romans or the Phoenicians. You thought that you could simply devaluate your money and nothing would happen, but it does happen. This is what happens. So you're purchasing bonds and you're issuing as much money as your central banks need without even worrying about the future. But when you do this sort of crazy things, in the end, it's really a folly, and you're generating inflation. This is inflation, increasing the number of bills in circulation, and you're increasing the monetary mass. This is the money that is the money supply, how it has grown. It has increased in the last 10, 12 years. It has increased in a very fast way since we were no longer rooted in gold. And in the US, it's actually been exponential. The growth has been exponential. So when you generate inflation, which is what has happened in the end, that surfaces. So during the last 10 years or even up to a year ago, that inflation could only be reflected in two things: financial markets and the real estate markets. So people who were saving, who saw a 0% interest rate, would invest in either the stock or in the real estate market. Obviously, that's what we did the world over. So here we have seen that the stock exchange in the US has gone from 10 trillions to 40 trillion from 2010 till last year. 3-4 months ago, we had that maximum, and we see an exponential growth of real estate prices in the US. So that increase of money supply didn't really affect the products that we buy on the daily, but rather it affected or impacted the real estate, and it caused the enormous distortions that we have seen. We saw that shares were going up and others weren't going up, and that is benefiting us right now. It didn't benefit us for a very long time, but now it is benefiting us. So in general, that has been the impact, and our way of managing has made the difference. When we saw that our shares were going down and others were going up in an absurd way, people would say, why? Well, when you do a folly such as this, things may happen, unexpected things can happen in the economies. And what happens? Well, after COVID and after the economic activity not being benefited by that increase of money supply until 2020, because that monetary mass was in those two sectors that I was mentioning, which is real estate or stock exchange, and was also maintained in the banks because companies and people after the financial crisis of 2007, 2008, 2009 didn't want to be in debt. So there wasn't really an excessive consumption, and the prices of products were more or less balanced. But with COVID, that changed, and it changed due to two reasons. First of all, because we decided, as we explained last year, to forget about the financial system and give money directly to people. And people, what they did was spend it. Obviously, some people saved it, but most of them just spent it. And they found themselves in a situation where, on top of being in a situation where we had created money above the productive capacity of the system, on top of that, the system stopped producing due to COVID, obviously, and there was a complete offset of the money that was in circulation and the products that could be bought. And what happened is what we're seeing now.
Pues que como hay menos productos en el mercado, pues
So now we have more products in the market, and everyone is competing since there are less products in the market, everyone is competing to get them, and the prices go up because we all have more money in general. I mean, some people have less money than they used to, but in general, we all have more money than we used to. And this is the situation. How is this going to continue? Well, this will continue if we do not reduce the money mass that we find in the system. So we see that interest rates are going up. They will have to grow much more. It's probable that will slow the economy down. So there could be a recession, greater or lesser in magnitude, but it could be like in the 40s. Volcker, the president of the Federal Reserve, had to increase the interest rates so that they could stop the inflation in the 70s. And now we're in a very dangerous situation, even more so than that time, because the state debts were reasonably limited, and the increase of the debt of states has been enormous in the last few years. So that increase of interest rates is going to make public deficits even greater and public expenditure even greater. We will have to do something. We will have to reduce it. It's the case of Spain. 1,400,000,000,000 debt. If we have our rates go up, that would be 75 billion in interest on top of that. And no matter how much we cut our expenses, we will not be able to take that on. That will be an important problem for the Spanish state. We will see how we can solve that. That is the situation. It's the situation that was very obvious. We knew that it would come. And it was obvious for everyone except for the central banks. They thought that it was temporary. Well, and we have to correct a very important defect, which is being mentioned in the in our sector, and we've come to tell you how real things are. The prices of oil going up is not what's causing inflation. There is an increase in oil price because there is a scarcity of oil and gas, not because there is an inflation problem. Since there isn't enough oil, enough gas, then the price goes up, so that we can have an adjustment of offer and demand in a situation where the monetary mass is stable. If the price of oil goes up, then we will consume less Netflix because we will have to pay more oil, and we will consume less Netflix because we have the same amount of money. But since now we have more money, then it's a bit chaotic. We have an inflation. We don't know what is going up, what is going down, because everything goes up. But relative prices also go up, and in Europe as well. Energy prices going up represent 18% of the consumer costs and expenses, and it's going to be even greater. So in order to conclude with inflation, what do we expect from inflation? It will continue unless there is an increase of interest rates, so that we can take the whole system back, all this bond system back. And European central banks have seen their balance increase until we do not reduce that, so that they stop issuing bonds, and those that
con una situación inflacionaria, ¿no? Que a nosotros,
and when the bonds are mature, they will not be renewed. So it's not that because we would rather invest in invest in fixed income, we think we don't mind about it. No, that's not true. I mean, we see in all companies where we're present, all the companies that are in our portfolios, they see that prices are going up because raw materials are going up, so they have to keep their margins, and that is why they are having an increase in their prices. But we as investors, we're not really facing a risk. As asset owners, we are quite defended with regards to inflation. The ones who have problems are those who have their money in banks, in fixed income that is losing money, because if you have a 10-year bond with 8% inflation, you are losing so much money after 7-8 years that it's not attractive anymore. So that is a different problem. That is our vision with regards to inflation. And if we review our portfolio, we can see how we're positioned. Here we see the evolution of our portfolios with the increase that we have seen in the last 18 months. We have recovered at least our initial levels. And obviously we are still below what the index shows, and we are getting closer, but we're still below. And as always, we insist that the most important line here in the long term is really the green line, the line on top of things. And this year we finally managed to tug from it upwards. So now we see that the value of our portfolio is around 225 per share according to our valuation. And so this is obviously our evaluation. You don't need to trust us if you don't want to, but that is the work tool that we use. These valuations that we do are the ones that guide us towards selling or purchasing other shares or assets. And we have seen an increase that is normal. It's the one that we should have had every year, but for some reasons we didn't have it in the previous years. And this comes from the fact that fortunately we are starting to see strong movements in the portfolio. So some of the shares have gone up quite a bit, and we can resell them, we can purchase something else. It's a normal game of movements in the portfolio. And we can find others, So we don't have any values right now in the portfolio that we think is worth less than 100%. So if we see the description of our portfolio here, the description that we have here, we see the reason why. So mainly in the second line, but we insist that we're always talking about high quality companies with a 20% return on the capital for the businesses themselves. So these are businesses where you put 100 and you will take 29 out of it during the first year. That's the business, the real business. So if they have invested 100 in assets, in cash flow and machines and so on, they will get 30 out of it. And the average of businesses, public businesses, is 7-8%. That's the return on capital. Those are very, very good businesses that are very hard to replicate. But what's most important is that right now our PER is at 5.8. We have recovered 100 in our funds, and we have seen some important increases, and we have managed for the PER of the fund is 5.8. That means that in 5.8 years, less than 6, we have paid for our investment, and all of our businesses are for free from the 6th year onwards. So our risk is very, very low with great potential. So if it goes from 5.8 to the reference index, which is 13.7, well, then you would have to pay for 13.7, then we will double. That is the objective, and that is what will happen with time. We will see when, but one time. And a different way of seeing fair is that free cash flow, the free cash flow is 24%. So we put 100, and in the companies where we are investing, we get 24. So it's not exactly like that. It's not the opposite to 5.8, because many of the companies we're in have a lot of cash flow and a lot of treasury. So these are family companies. 2/3 of the companies we invest in are family companies, and the VAR, which we have to explain. Obviously, that is the loss, the possible loss that the fund could have. This would be a maximum loss of 12.5% per month. So in a very specific month, we could maybe see a loss of 12.5%. And this month could be one of those months where we have that drop in value. Obviously, the volatility of market could in the short term affect us, obviously. So now let's see the international portfolio. We did it by blocks. So the companies haven't really changed. As you can see, since they're public, you already know which ones they are. And we have increased energy from 40 to 46%. And in the fourth line, you see that we have oil and gas infrastructure producers. So what we had last year was that the price of Brent went up. The price of oil and gas also went up. Before the war, it was around $80-90. And most of the oil companies had been lagging behind. So there was a dysfunction in the market. And why was that? Well, mainly because it wasn't really fashionable to invest in those companies, but now we have seen that it was necessary to invest in them. But we will talk about that in greater detail later on. So we have increased our presence in energy. We have maintained our weight in defense. We talk about Babcock. We talk about TIF with their residences and the Asian companies that have great cash flow and great treasury. We have companies that have very stable businesses where recession would not affect them. And we have reduced our cyclical component, mainly because we have sold Porsche and some other companies that weren't as heavy, but we have 13% of that sector. And you have to understand that the cyclical companies that we had in our portfolio had important reductions in. I mean, we were not having cyclical companies at the maximum at the top of the cycle. And the natural movement, as the values go up, defense goes up and energy goes up. Well, to us, it would be to then go towards other cyclical values such as cars, retail, and things that depend on the economic evolution. And the rest is actually very small. That energy obviously has raw materials, but then we have lots of different shares that could be called miscellaneous because they're different to categorize. And now going back to Iberia, we have the same, really. We haven't really been lagging as behind as with the international landscape, but here we have the gray line, which is the reference line. And once again, what's the potential is enormous. If we take a look at all our shares, all our assets, it's in a market with 120 different shares, we could not purchase something for half its value. I would not expect to be able to do that right now. With all the money that we have in the market right now, I could not expect to to purchase a euro for 50 cents, which is what we're currently doing in the Portuguese and Spanish market. It's completely unexpected, but we've been able to do it, and we have told you about this during the previous conferences. So now the situation is even more dear because many companies have a lovely behavior, but the market is not reflecting it. And in the end, going back to the valuations and the objective value that we give to things, obviously we're always going to get things wrong in some companies. We've made mistakes, many mistakes, and we explained 13 years ago that ever since we started investing in the international portfolio, we have made 50 to 60 mistakes, so 2 to 3 companies a year. But we're also going to make the right choice with others, because sometimes life surprises you in a good or in a bad way. So obviously the valuation that we do is actually quite objective, and in the last 2 years we have refined actually our process, and I think that we have only made one mistake with our big companies fund, and for the rest we can obviously discuss whether they're better or worse, but a 70 to 80% drop with difficulty to recover that drop, that is a mistake. And there's always been 2 to 3 per year, but now we have been not having those problems for 2 years. We only had one mistake, such as those in the big companies fund. So we think that the objective value that we give them is actually true. We're happy to see it grow, and we think that it will keep on growing during the next few years, and we think that we will not see the problems we saw in the last years, such as in 2018. And we will go on. And as for the Iberian portfolio, I have to say that the characteristics are quite similar to the international. We have very good results. Obviously, we have companies with an entrance barrier. It's not just anything. Our PER is 6.8. PE, I'm sorry, is 6.8. It's very difficult to obtain this value. Free cash flow yield is 14%. So that is the opposite of the PER. So here we have only family companies. Most of them have been known old friends for a very long time. So you can see that the portfolio's value is a bit lower than the international one, but in the end I have to say that we love volatility. Volatility is that which allows us to do things, especially when there is a relative volatility between funds, because sometimes some values drop a lot, but that allows you to play with others that are going up quite a lot. So this volatility always generates value in the long term. It's just a source for value. So sometimes it might not be nice, and maybe some people will give me a call and say, what happened yesterday? Well, it happened as it sometimes happens. Stocks go up and down, and it's a world of movement. Now, as for the different blocks in the Iberian portfolio, we have less investment in energy. There are less exposed stocks, and we have a very defensive portfolio. It's difficult to qualify companies as defensive, but I think that there is a bit less cyclical. And during the last quarter, we have sold Metrobacesa, and I have to say that we purchased them quite well 2 years ago, and maybe these assets are not they're undervalued, but to be honest, we were not really convinced with what the sector looked like. And we saw what happened in the US, and we thought that in Spain we also had, a certain movement that we're not talking about 2007, 2008, but I don't know to what extent an increase of interest rates from 5 to 6 could maybe have an impact in the sector. So we decided to be a bit more cautious with regards to our position in the real estate sector, which is very low right now.
Raw material 17%, and the rest is a bit of a mixed match. And now Juan Huerta and Vicente are going to let us know about our investment thesis on energy, on power, and this is very important in current times. So I think we're going to first give the floor to Juan, who will address us from his home. We're going to talk about oil and gas, but everything's so green, isn't it? Hello, good afternoon. Can you hear me? Yes, we can. Good afternoon. I would like to start by saying that I'm sorry that I haven't been able to join you there at the auditorium. It's something that was outside of my control. We considered that this was going to be the most prudent format, so I hope it works. As Paco mentioned, I'm going to start off talking about our thesis on power investment. It's a sector which is quite remarkable for us in the international portfolio. Its weight is not it's not as remarkable in the Iberian portfolio, but we are now going to share the details with you rather. We're going to talk about the energy demand overall, regardless of whether it's nuclear power, renewable energy. Regardless of the sources, we considered that in the long run we're going to need more energy around the world because of two main reasons, without making trials and tribulations here. Because first, population is going to grow. This has been happening in the past, and the estimate is right now there's 7.8 billion people on the globe, and it could go up to 9 or 11 billion in 30 years. This is something that we consider to be quite logical. And the second and very important factor is the development of economies, which has also happening from the aggregate perspective at the global level. In order for this population to grow and for the economies to develop overall, we need we know that there needs to be an increase in energy, in power. They both go hand in hand. So without being able to, of course, forecast in great detail where everything's going to be headed to, we do consider that there's going to be a large increase in energy demand. So with our eyes on 10 and the future 10 years, the 30 years. It's not us telling it. It's the great consensus that exists in the market across experts and investment banks that estimate that the demand for energy at the global level is going to be growing going forward. This is what we have tried to illustrate on this graph. Each of the different graphs illustrate the different sources. We have Shell, BP, Exxon, the IEA, and all of them considered that by 2030 there will be a global energy demand that exceeds the one that we had in 2019. And this is displayed on the green bar. That would be the situation in 2020 compared to the gray bar, which is the one that portrays the situation in 2019. So to the right, we have the Paris-aligned scenarios. This come from the International Energy Agency, and we consider that they're very difficult to achieve, which is the zero emission scenario by 2050, and we consider this is going to be very difficult because of many reasons that we will explain during the Q&A, and we think that it's going to be very difficult to achieve those. So the baseline is that we consider that there's going to be an increase in energy demand in the future. So the question that should come to mind immediately is, where will we source that energy from? What will be the energy sources that will allow to meet that higher energy demand that will happen in the next 10-30 years? That takes us to our following slide. Of course, we in Cobas, we are not against the current just because of the sake of going against the current. We do consider that renewable energies have a key role and an important role to play in the context of the increase of demand for energy in the future. But we don't think that renewable energies will be the ones that will solve this problem. Renewable energies will grow a lot, but we think that hydrocarbons, oil and gas will play a very important role. Oil and chiefly gas will play a very important role, and they will become very necessary. This is what is displayed on this graph. On the bar that you see to the left in gray, we display the demand for energy at the global level, and we are trying to cover how this gap is going to be covered until we manage to meet that estimated demand by 2030. Where will this energy come from? Chiefly from renewable energies, but we still need an increase in the supply of liquefied natural gas, oil, and gas. Possibly coal will go down, but JP Morgan, which is the source of this graph, they estimate that there could be an energy deficit, even if there's an increase in renewables, oil and gas. If coal decreases, there won't be enough energy from the aggregate perspective at the global level in order to meet the potential demand that we could have in 15, 20, or 30 years. So the starting point is that indeed there will be a need for more energy, and that either hydrocarbons, oil and gas chiefly, will have a very important role to play. On the next slide, we can see, on the next slide by the IEA, we can see that there will be a need for more oil. How much more? Well, it's impossible to know it, and it's not part of the scope of our work to do precise forecasts as to whether it's going to be 105 million by 2050. But we consider that because of everything that we explained, it's logical that there will be a greater need for energy, and that part of that energy, part of those energy requirements will be met by oil and gas. In this case, we want to underline oil, which is 31% of the basic primary energy matrix by 2020, and the IEA, which is sometimes more biased towards the demander, those that demand oil than those that supply it. They still estimate that by 2030, oil will continue to be 30% of the energy matrix. So it'll remain practically stable. So if it remains at that 30% by energy demand by 2030 is higher, then from the absolute perspective, we will need more oil. We don't know how much oil, as we mentioned before, but potentially there will be a need for more oil to be produced by 2030. So that has to do with demand. On the next two slides, we're going to be talking about what's happening with supply and what is causing the imbalance between supply and demand that we are seeing today, and that is giving rise to this very high oil and gas prices. We see a great imbalance between the amount of oil being produced, and gas too, we will see that later, and the amount being demanded. As long as demand in any economic sector exceeds demand, exceeds supply, prices go up, they shoot up, unless there is a new balance. But in the short run, indeed, prices skyrocket. So in the recent past, in the last 5-6 years, what has happened is that there's been a generalized lack of investment in the oil and gas industry. Here we can see it on the graph. In green, you can see the investments in billions in oil and gas. It peaked in 2014, then it dropped sharply with the excess production coming from US shale. We'll know about that because we've read about it. And then there was a new peak in 2020 and a new drop in 2020. It's gone up slightly in 2021, but in light of this graph, we need to focus on how far the investment level is still from what would be required in order to produce enough to meet the demand that we could have in 10 years' time, in 2030 and beyond. And that's displayed on the gray line. This is the capex estimates that would suffice to meet demand by 2030. In this case, this graph is sourced from Barclays. We are quoting different sources, but it's necessary to mention that there are top tier type of categories, but we want to do this so that you can see that we don't just draw from sources. So there's a need to invest much more to meet the potential demand for oil and gas that we will have going forward. And because there hasn't been sufficient investment made, what has happened is the following. There's been a generalized lack of investment, and there's a dynamic in the oil and gas industry that has a geological basis, scientific basis. Every time an oil well is dug, there's reserves in earth which are limited, and because they start producing, the amount of reserves decrease. If there is 100 in the reserve and you continue to produce, that reserve decreases. That's like the natural destiny of oil fields. So in order for that to be maintained, you need to have constant investments, because it's a capital investment, this industry. Because in the last few years, there haven't been any investments, as we mentioned before. This decline is taking place, and this is one of the main reasons why the oil supply is not managing to meet the demand that we currently have, and this is giving rise to the prices that we see in the industry. And this is very well reflected on this graph by Saudi Aramco. On light gray, we see Saudi Aramco's estimates, which is the main oil company in Saudi Arabia and the world over. And in the stock market, they're very similar to Apple in their industry. And if nothing is invested, if no money is invested, we would go from 100 million barrels down to 40 million barrels in 2030. But if we remain with the same investments, there will also be a very important drop, which is reflected on dark gray. Therefore, there will be a need for new investments, and that is displayed on the green part of the graph. That would help take the oil production up to what Saudi Aramco estimates to be 106 million barrels. So in order to be stable or exceed the levels that we have right now, we need further investment. And Vicente will explain how we are exposed to this dynamic through infrastructure and service companies to make these investments that would suffice to meet the demand going forward, the demand for energy. And this takes us to the next slide, in which we will be talking about gas, which is the second hydrocarbon that we mentioned in the beginning, and it'll be necessary to increase its production in order to meet energy demands in the future. And in gas, we see similar dynamics as in oil. There hasn't been enough investment made, but not because of the same situation as we saw in gas, because of the energy transition, because of e-vehicles, but rather because they haven't foreseen sufficiently well the sharp increase in gas that we're witnessing. According to IEA, they estimate that gas is going to increase its weight in the energy matrix, not unlike oil, which will remain at the same level. Gas is not as pollutant, so the hydrocarbons, it pollutes 50% less than coal and 20% less than oil. It's way cleaner. There's a lot more gas in the globe, and it's easier to extract it and transport it thanks to infrastructures that we're going to be mentioning in the future. So it's an interesting power source. We can see that there is a need for more gas, and as we're going to see in the following slides, this has accentuated in the past, and it's becoming more and more problematic because of what has happened with Russia's invasion of Ukraine. And here we want to show the dependency that Europe has from the energy perspective. 90% of gas in Europe is imported, 90% of oil, and 77% of coal. But even more so, 40% of gas comes from Russia, and 25% of European gas comes from Russia. We are strongly dependent from abroad, and especially from Russia, and experts are indeed raising that this is a problem. So we're not just talking about energy transition. Also in conversations at the forefront, we have the issue of guaranteeing supply, because indeed energy transition is key. But if someone decides to cut off your gas, you won't be able to turn on your light, and the automotive industry will have to come to a stop if what happened last week happens indeed, and Russia decides to cut the supply of gas. So we are seeing that guaranteeing supply is key. Gas is going to play a key role, and talking about gas, we should focus specifically on LNG. Why LNG? Why are we focusing on liquefied natural gas? Because gas has indeed an international production. It's internationally produced, but most of the liquefied natural gas that is produced is consumed nationally. And where is it extracted? Well, chiefly in the US and in 2 more locations. But there's great demand in Europe and Asia, so gas is not produced in the same places as it's demanded, and you need to transport it. You can do it through gas pipes, through pipelines, which are very useful, and they can use at the regional level, because you can create a pipeline in Europe, but it's very complicated to build one between Europe and the United States crossing the Atlantic. So when we're talking about very long distances, we need to use LNG, and it needs to be treated, it needs to be exposed to a very high temperature so that it can be converted into its liquid form, and then once it's regasified, it can be consumed. We later on will explain where we are positioned in the value chain, which has a very interesting growth trend going forward. So on this graph, we wanted to talk about the two main regions where there's a demand for LNG: Asia and Europe. And here there's something that we need to mention, which is that the European Union has recently stated that in order to not have energy dependency from Russia, they said that they're going to do this year. I think it's impossible, but they will do it in the short run. They're going to stop sourcing those 120 million tons that they were sourcing from Russia, and they're going to get liquefied natural gas instead. So the amount of LNG that's traded at spot in the daily market and the rest of gas in long-term contracts. So the available gas, it's 150 million tons, and there's already a demand for that in China and Asia. So what the European Union intends to do is to take those 150 million tons that are available right now and take those to Europe. Obviously, that's not feasible. If we were to do that, there would be a price war with Asia, and gas prices would shoot up. What we have experienced this year would be laughable. So that would be very complicated. So we need more LNG. There's an increase in demand, especially due to what's going on from the geopolitical perspective. And on the next slide, we can see how production is not enough. Supply is not enough. Because of the same thing as we explained when we were talking about oil, there haven't been enough investments, especially in LNG projects, due to several reasons. Because sometimes gas is very much linked to oil, because you stop drilling for oil and you stop drilling for gas, because once you drill for oil, gas comes up too. From the energy transition perspective, until very recently, this was not admissible in Europe until it has been recategorized together with nuclear power. This was a sector in which companies didn't want to invest. They had to get financing at 9 and 10%. Companies that had net cash flow had trouble doing this. So it was a very difficult situation, and there haven't been enough investments. And this is what's displayed on the graph. In 2022, we can see the existing capacity, how much can be produced in terms of LNG at the global level. And in gray, we see the estimates by Morgan Stanley. This is the demand. More is demanded than produced, and then therefore prices shoot up. So this is there's a consensus that this situation is going to remain in the next 4 years, because we should have investing in LNG projects in the last 5 years in order to meet the growing demand. And this is a problem that has increased because of what's happening in Ukraine, and with the attempt to guarantee European supply from outside of Russia. So this problem has even worsened recently. On the next slide, I will wrap up by saying that what's going on in the oil and gas industry, as mentioned by Paco, it's not that prices are growing because of inflation. It's a basic economic rule. There is an imbalance between supply and demand because of the reasons that we have just explained. And in order to offset that imbalance, investment is required, and some companies are very well positioned to make these investments, which we think will happen. But in order, a large part of the market is not convinced by this investment thesis, and this is what we wanted to show in this graph. This is the amount of investment funds that are overweight in energy. The average is 45%, and many are below that average. And this graph goes to show that still in the investment industry, not sufficient investment is being made into energy, because this thesis, they don't consider that the thesis that we are sharing with you is correct. And this is why we have been able to find very good, interesting investment options, because there is a great undervaluation between what we think the companies can offer and what the market thinks. And if the market were to think this, the gap would be bridged, of course. And I am now going to give the floor to Vicente, who will share with us how we are positioned at Cobas. Thank you. I was going to encourage Juan to get better soon, but I don't think he's any longer with us. After hearing what we think about the energy sector and how we expect energy demand to grow, basically because of the increase in population, every 13 years there is an increase in 1 billion, and because of economic growth, there is a sharp increase. And if we add to that there are some balances because of the lack of investment, as Juan explained, in the oil and gas industries. Now we need to consider how we are exposed to this in our international portfolio. In order to illustrate this, I'm going to share a few brushstrokes considering the main aspects, the main positions that we have in energy. This year we have 46% in the energy portfolio, and we have reduced the exposure this year to two segments, natural gas transportation, and we have increased exposure to oil production companies and natural gas production companies. In the energy sector, there's four key industries to which we are exposed. The first one is natural gas infrastructures. There we have 11% of our portfolio, basically on two companies, Golar, which is our main position, and Exmar. Why are we invested here? Well, because as we have explained, there is a need to have more LNG because there's an increase in demand, and because of the increase in Asia, and because of energy matrices in energy in China and India. They're based on coal right now, and natural gas helps reduce coal consumption and replace it by gas, which is less pollutant in terms of CO2. So it's a way to replace those technologies and move towards more efficient ones. And also because everybody can agree on the fact that the renewables are developing, of course, but we also need technologies that can guarantee the supply. We can all understand that if wind is not blowing or it's not hot, we will need other replacement energy sources to guarantee supply, and this is why natural gas can be a great support there. And something that has also happened is what we mentioned before, Russia's situation, and this has indeed pointed at the fact that we will be needing more LNG infrastructures going forward. We also have investments with Exmar. They have long-term contracts and they focus on part of the value chain in the LNG industry, which is exploration and production, and then they liquefy gas too, which is basically transforming gas from gas to liquid state at minus 160 degrees using cooling systems, and this helps gas occupy less space so that it can be transported on methane boats, and that way it'll be taken to coasts, and then we could have floating or fixed regasifier plants, and we are exposed therefore with Golar and Exmar to floating regassing plants, and also on gas transportation. Why are we mentioning this? Because this offers long-term contracts. Golar has 15 or 20-year long contracts, and they require important investments in the beginning. It's 1.3 billion, and they pay a fixed amount, 200 or 300 million, depending on the contract. That would be an average contract. And this is quite interesting. It's quite a stable segment. And from the standpoint of valuation, given the projects that they have already signed up, this is trading at 6.5 operational EV, normalized EBITDA. And how does this compare to other companies in the sector? Well, compared to other LNG companies, we see that this is at 10 times, and between 9 and 10 times. The assets that we currently have are trading at a discount, but there's a need for infrastructures going forward, and we consider that they're very well positioned to get more liquefaction contracts in the case of Golar, and we hope to hear some good news in the future, in the next few months. The second segment would be that of oil and gas providers and sustainable technologies. Here we find 11% of our portfolio, just as like in the previous segment, but here we see 6 companies. Why are we invested here? Well, because as we explained before, there's a need to invest in natural gas and oil projects. In oil, because oil wells of course, undergo a natural decline. We cannot live off the barrels that go back a few years' time. If we don't invest right now, there will be no oil going forward. And we invest in natural gas because there's ongoing growth because of the demand coming from Asian countries, and also because of the issues in Europe to replace Russian gas. So here we see a series of companies that are part of the value chain, and there's a bit of everything here. We see some that work on the gas processing plants, refineries, petrochemical plants, and we're also positioned in sustainable new technologies too, in the pipeline of new projects indeed that they're starting to consider in upcoming years, between 10 and 13% also include new sustainable power technologies, and this goes back to trending topics such as hydrogen, recycling, the conversion of plastic into methanol, circular economy. These are sustainable energy projects, and everybody's saying that there's a lot of investment going on here, and possibly these companies in the future will receive a share of that income. These are trading at 5 times normalized profit, and because they're very heterogeneous, I didn't want to share any comparisons because I didn't think that they would compare too well. Technimont focuses on petrochemicals, but they also work on fertilizers. There's also the companies like, for instance, others that work on and different types of energy. So it's very heterogeneous, and it's very difficult to make comparisons. In the next company, it's 11% of our portfolio, and they're exposed to transport of gas and oil. Here we have oil transportation through oil tankers, based on oil tankers, and the reason why we have invested here is because there's an imbalance between supply and demand. We see that there's an ongoing increase in oil demand, and on the other hand, that service is delivered through oil tankers. And this has to do indeed with supply and demand, and the current oil tanker base is quite aged. 25% of the current existing fleet is more than 25 years old, so their useful life is 20 years, and they become scrap. So this is a very aged fleet, and from the side of new boats, we see that there's little demand for new boats. In the last 9 months, I was reading this morning that no boats have been contracted. So there is a growing demand, a stable supply, roughly, and this is going to give rise to a greater use of those boats and tankers. There will be more fleeting and more profitability. And then we have natural gas transportation. Here we see methane boats, and we have a gas pipe company, Energy Transfer, and this company has its assets located in strategic areas in American basins, and they have gas pipes in key locations, and what they do is to transport gas to production centers. This is a very interesting company that we bought a few years ago. They cut off their dividends by 50%, so it was an opportunity to buy a quality company with good assets at a good price. See, these are traded at 7 times EBITDA, and to compare that with the reference in the sector, that's at 9 times, so they're trading at a discount, and they're going to benefit from the growth in infrastructures for gas, because indeed, if Russian gas needs to be replaced, it'll have to come from somewhere. In Europe, fracking is not allowed, but in the United States, it's allowed. So we'll possibly need American gas and gas from Qatar in order to replace that gas. And from the standpoint of valuations, oil tankers are at 0.7 net asset value, and the comparables, according to Clarkson, are at 0.9 the net asset value. So once again, these are assets at a discount and with an imbalance between supply and demand.
And lastly, the segment of those companies that produce oil and gas. Here we have 7%. We have increased during 2021 our exposure to this segment. Mainly we had last year Cosmos, IPCO and Capricorn, and this year we have added 4 new companies, and basically here we are exposed to that imbalance between offer and demand, which causes for a lack of investment and and the barrels are not being produced, prices go up, and we are benefited from that exposure with these companies that are producing oil. So while there is that imbalance between offer and demand, we will have a great working capital. And these companies always have the cash flow dedicated to investing, and shareholders were always a bit forgotten. But lately we are seeing an offset of that situation. So now we obviously have to keep on investing. That's obvious, but we also have to tend to our shareholders, who are important as well. As for valuation, these companies usually have a stock that is 4 times over the normalized value in 2024, and we have to understand that their PR is 6.3. So we have other models. We normalize this part of the portfolio to 60 Brent, and the same thing for gas at the current prices. And the comparables are 15-16 companies. We have taken 15-16 companies in the US and Europe who usually have 6.3 at 2024. So we see that there is an important unbalance here with regards to our position. And I'd also like to tell you, before I close with this presentation on energy, because as we have seen, it is a very undervalued sector, energy is. And when we look towards this sector, we see that we get a reasonable coverage to protect ourselves from inflation. And of all the companies that we have in our portfolio, the 20 companies that we have briefly explained here, 25% have a 60 to 70% have an owner who is with us, and we like going hand in hand with them. And an important part of our portfolio, as we said previously, has long-term fixed contracts, such as those of our LNG companies. So there is a good balance that will allow us to benefit from the unbalance of offer and demand. And that is all I wanted to say. Thank you so much.
Gracias, Vicente. Gracias, Juan.
Thank you so much. That was a very interesting explanation. I hope that it was also interesting for all of our guests present here, and I hope that it was pedagogical, because it is a very important presentation. I think Vicente has explained our exposure. It's a very varied exposure. It's not monolithic. It is not oil goes up, stock goes up, and oil goes down, stock goes down. No, there are long-term contracts. There are different exposures. You have different exposures in LNG and oil, oil services, investment in those drilling and extracting oil. But I insist that our figures are at $60 Brent, and that is essential. It's not at a 108 as it is today. It is as a $60 Brent price. So when we crunch the figures, it all comes out as it should. So we purchased them when it was at 60. If the Brent maintains at 100 for 5 years, then the objective price of 225 will become 240 to 145. So I think that's sufficient. And if Brent goes down to 30, then the objective price will also go down. But the perspective of Brent going to 30 with the dynamic that we have in the offer demand is very, very low. And we work with odds. We don't work with certainties. So we have an exposure that is quite high, quite varied, with not much risk with regards to the price for the final product. And that is why we have it. And we clearly have a situation where there is an imbalance between offer and demand, and it's important, and we're benefiting from it. Now we're going to look at the situation of the Santa Comba group. We're going to talk about pensions first, Cobas pensions, which is a group that interests us all. We have changed our employment plan, Cobas 100. That is something we offer to companies, and we have many companies promoting it, and they obviously are changing their company's plan. And as we see with the legislation change, this becomes a very interesting alternative compared to traditional pension funds that have reduced their interest, although we obviously are getting much revenue from pension funds. But it is true that this is a product that is good for the future of companies. In many other companies, such as England, this is actually developing quite a bit. We've also lowered the commissions of the pension funds, and we have Cobas Empleo as well. That is quite modern, quite updated, and we hope you like it. We also keep on doing activities with a community with 400,000 users, all sorts of users. It's amazing. And we're trying to generate enough content so that it'll still be interesting and it'll still grow, and so that we can still have what we originally strived for, which is getting more knowledge. We have the books that we have issued, that Value School published. We have one that is very, very interesting that we have just published, which is the moral question of fossil fuel, that explains the history of fossil fuel and what their role is in global economy. And since they are usually portrayed as a demon, we thought that we needed to understand what the history is and then judge how things really are. And we also have a new platform. I think it's interesting and you should take a look at it. Then we have the Value Academy, it's Value Academy, and we have something new, which is a documentary that we have created with Professor Jesus Huerta de Soto about pensions, that is quite disruptive, and it has been purchased by Amazon. So we also have our Global Social Impact Investments product. You know that it is working in Africa. We have launched the Spanish fund as well, the Global Social Impact Fund 2, the FESE for investments here in Spain, and it is really something that we offer to institutions, but anyone can participate here. We have London participating in it. I'm sure you already know them from Almiral's family in Catalonia, Unión, Repsion, and Esbat, and Santa Comba. Those are the main partners who launched the fund, and we will keep on trying to have an impact. And you also have to remember that, as always, we always dedicate 15% of our revenue. In these last few years, it has been, well, we've used 100% of our profit to all of these activities. So we find the Open Value Foundation has allowed us to help 6 new social companies. We have 20 foundations such as London. We have 18 new fellows of Acumen. And as you know, this is a very powerful association, a US association that has a lot to do with impact. So we don't want to lose sight of what our references are. So we have tried with our impact funds to move philanthropy towards, so from pure donation to something a bit more than donation, going beyond donation, trying to give sustainability to that donation so that it is not just something that can be only used this year, so that it can be sustained and so that it can be sustained in time. And we also have organized online courses. Over 700 students have been participating in them. And now reaching the conclusion, we would maybe have to look at the whole thing that has been presented. We have a portfolio that is defending itself quite well in this inflationary context, because all companies are having their prices go up, but our high exposure in energy pushes us beyond in this protection trend, because it's quite immediate. You know that raw materials, energy are the first ones that can benefit at a certain point from that inflation. I know that it is also true that we run the risk to suffering if there is a recession, because we are the ones that are placed further from the consumer. But in any case, we think that the energy dynamic is quite different no matter what happens. And I also insist in the fact that we have a wide discount to asset values. It is what it is, over 50%, and we think that sooner or later that will be reflected in the value that these funds have. So obviously we always have to make mistakes, but obviously the value of the funds will finish reaching the objective price sooner or later, because the objective value will always rise. And this is very important, and we repeat it over and over. And you're saying the same thing. No, it's just another year where we know the companies, and it's very important to know and have a very high level of awareness of our companies. Now, natural gas, everyone talks about liquefied natural gas, but we have always invested in this field. We think that we have a few possibilities of generating more value than others, after having been in this sector for over 5 years, because we started investing in ticket and LNG 5 years ago. So we then reached Gola and Exman and so on. So we really know the sector. And when you have been in the sector for 5 years, obviously, you become wise and you know what you're dealing with. So I think that it is due to these 5 years experience that we know as much as we know, and that knowledge is invaluable. And we have to keep on sending that message. The odds for us to make a mistake are much lower than 2, 3, 4 years ago in most of the stocks we're present in. Obviously, there will be mistakes. There are always mistakes, but the odds of us making a mistake are very, very low. And what we work with are odds, not certainty. So, and here we have, I mean, in every market, there will be high upside potential in any market environment. I already said it. I've said it a number of times. I know that you will say that I am too repetitive, but remember the years 2000, 2001, minus 40% of the international market, and then our funds and differential. I'm afraid that we are following the same line. I think that we are following the same line because it's true that some companies have really fallen quite a lot, but we still don't see much value in those companies that fell 50 and 60%. And I think they still have some way to fall. So it doesn't matter if other companies in the market fall and if the index falls, because we think that when our portfolio has a free cash flow 5 to 6 times profit, we will always see good things coming in whatever environment. It's true that if the whole stock falls if the whole stock falls, then it will be much more difficult for us to have good results, but we think that we'll do well. And thank you all for coming, and we can now start with a Q&A session. We hope that we can answer your questions. I think we have until 8:30 to answer your questions.
Vale. Buenas tardes.
Good afternoon. Before we start with the questions, we would like from the Department of Investors Relations to say a few things about non-conventional communication channels, such as, for instance, calling us directly or these annual seminars. But you should also learn that we have a YouTube channel, that we also have a podcast on a weekly basis. We have a new podcast. And I'm sure that in the social network channels, you can also find information. And to your questions, I mean, all of you who are here today and those who are connected online, you can ask your questions online by filling out the form that you have received. And obviously, all of you here today, you can obviously use the cards that have been put at your disposal that our hostesses have around the room for you to fill in. So let's begin. The first question was asked by Andres, and he was saying that after these years of a low profitability in our funds, low performance, do we think that currently our companies will have a behavior that is way above the market, and are we protected enough to have positive performance discounting inflation? Yes, that's exactly what I just said. This is a game of odds, but the odds are quite high. When you have 5 to 6 times free cash flow, your profitability should be high, especially when the market is at 14 times free cash flow or 17 times free cash flow. I mean, that's what should be the case. And then you can have 2-3 years, such as the years when people only invested in a few companies that we all know. And what can we do? Well, we can only open our umbrella and wait for the rain to stop. And that only happens every 10, 15 years, 20 years. So it doesn't happen every 2-3 years. So I think it's our turn now. And now this is linked to what has already been said during the conference. Gregorio is saying that in the last 18 months, profitability has been very good. Performance has been good thanks to the good behavior of energy companies. And what they're telling us is that they see that we increase our position and our exposure in these companies, but also in traditional companies, for instance, Populis, Chip, and so on. Renault. So he's saying a few companies, a few businesses where we're exposed that don't have to do with energy. And he's asking us, why do we trust in these companies that are not in the energy sector, and why don't we increase our exposure instead of 46%, why don't we have a higher exposure in energy? Well, you have to be prudent. You have to have a bit of everything in your portfolio, and we feel quite comfortable with the amounts that we have, and we could not invest 40% in exploration and production companies, because then we would depend on the price of oil, and then we would have to wake up every morning thinking about what the price of oil is. No, we have to sleep easily at night. That's the most important thing. We need to be able to sleep at night. So we need to be exposed, but in a moderate way, and we can't have too much exposure to oil. So in the end, really, we've already said it. 99% of stock, 99%, or the 50-60 that we have in the international portfolio, and 30-40 that we have in the Iberian portfolio, they all are worth twice what they are. Why don't you invest in banks, or why don't you sell more of this or buy more of that? Well, obviously, yes, it's a very difficult decision, because who do you love most out of your 5 kids? It's impossible to make the right choice, because, I mean, all companies are so cheap right now that it's very difficult to choose. So what do we try and do? Well, we try and have a cost of opportunity that is as low as possible. So what we try is we try and choose those that in the short term are behaving best. That's what we try and do. Look at the short term in that decision-making process, which is very complicated, because we have to meet every week, and we have to look at a series of stocks that are foreseen, because we have 4 or 5 stocks and we don't have space for all of them. So I think that all of them are twice what they were when we purchased them. So what do we do? It's a very difficult decision. So that's where we stand right now. So what can we do? What can we do on the dailies? There's no answer to that. The question asked by this gentleman is absolutely correct. Investing in anything, that's always correct. Always correct. The question is, how much and which one should be the fastest investment? I mean, we always make mistakes. You think that this will happen this year, but then it happens in a couple of years. You never know. From the Más Dividendos forum, they're asking us 2 questions that have to do with PR. And the first one is, have we ever purchased a multiple that was over 15 times for a company that has a very high growth forecast? And they ask us if we argue not to pay a high PER when purchasing a company, but when we purchase cyclical, we could purchase them at a high PER because the benefit is going to grow. So they ask us what's the difference between one style and purchasing companies with a high PER expecting for the profit to go up. No, actually, I think you have to choose what it is that you want to do. You all have your opinions, but I would never purchase a company that has over 12 or 11. 15 is way too high. But what are we talking about? We're talking about a 6-7 PER, 5. I mean, it's impossible to purchase a 13 or 14 PER company. And we already explained last year that many of the companies that we currently have are growth companies. Golem, for instance, has gone from 100 million EBITDA, and now they're 400, 500 EBITDA, and they will reach 600 in 3 years' time. So it's an absolute growth. And we could say the same thing about many other companies that we have in our portfolio. So we like companies that grow and sectors that we understand at a very low price. So for a series of reasons, that's the sweet spot. I'm sorry, I cannot find the words in Spanish. The ideal sweet spot would be that to purchase that sort of company. So a company that grows at per 15, that's great. Everyone knows that they're growing. What can we do? What can we add to it? Nothing. So we purchase as a client as much as we can, but we're not adding anything to it, are we? So out of the 60 analysts that cover Amazon, all of them have purchased and one is neutral. So that's not really adding anything. If Amazon is doing well, that's great, but the odds are against you. So in the end, what happens? If everyone is purchasing Amazon stock, the day that something will happen with Amazon, they're all going to crash. And maybe nothing will happen, but this is a game of odds. And in the end, the odds are like handicap, in the end you finally have a handicap, and that's how it goes. And the second question is the high PER in cyclical. Well, yes, that's true. In cyclical companies, you purchase them when they're not making money, so they have a high PER because they're not making money, they're losing money. So from an optical standpoint, you're purchasing them at a high PER, but that depends. Sometimes you have to purchase more cyclical than oil companies. And for instance, one of the oil companies that we're purchasing is it's worth 500 million and it's only making 100 and 150 million now, but it will make those amounts in the next 10 years. So they're cyclical, but since we are using 60 Brent, then we're already taking into account the cycle. But if Brent stays at 100, then they will make 150 every year for the next 10 years. But we cannot say that it's going to be 100 because we don't know it. So we use 60 because we think it's the reference price, so that there is new investment in the market. So maybe we'll be with them for 2-3 years with Brent at 80, 90, 110, 140. But what would be normal is for 4 or 5 years time to see an evolution of price, which will be the cost of getting a barrel, which would be around $60. So in the cyclics, the key is to know what the marginal price is at which a new barrel will be incentivated for it to be produced, and in this case we think that that is the price. So we have over 300 questions, so we are going to go from one topic to another because they're quite varied. So we're going to try and regroup those that are similar. We didn't talk about Asia, we didn't talk about our portfolio in Asia, and I think that there are a couple of questions. One from Thomas, who asks whether there are companies that have been affected by the Ukraine invasion by Russia, and then Pedro is asking if after the fall in the Asian market we have considered adding any more companies. Could you please help me out with these, because Minkun is not here, but I think that it's a small factor in Asian companies. I mean, what happened in the Ukraine and Russia. I think that the main one is Samsung, and I think that it has two businesses, Samsung Electronics and Biologics, and in Biologics the impact has been zero, like in any pharma, and in Samsung IT, well, maybe some in the logistics chain, Samsung Electronics, but I don't think it's been much of an impact. And really, the Shanghai lockdown and other cities, that doesn't have really an impact because we're not very much exposed in Asia. And Minkun obviously always gives us ideas, constantly gives us ideas, and some of them have entered the portfolio because we have new things this year, such as VTech, which is new this year, and for instance, and some others, and they compete with the rest of them. And yes, we do find some. Okay, so Alfredo was asking if we could update the investment theory in carries, especially because of the bottlenecks in Asia and the increase of costs and inflation. Well, the investment thesis in carries is still very similar to the one that we mentioned a few years ago, but the difference is that it has all seen an improvement. The cell phone business has improved thanks to the pandemic. They are now getting more market share. The company has generated and is going to generate much cash flow, and they repurchase their shares. So from the business standpoint, I think that everything is going brilliantly, but the thing is that it has not seen a reflection in their stock, in the stock valuation. Due to the fear of a recession, their stock prices has gone down, but the business is doing great. So the stock prices are not reflecting how well the business is doing, and that is why I think it's the second most important business in our international portfolio. As for bottlenecks, obviously this is affecting them, but the advantage that they have is that they're not number one in the market, so they're the first ones to receive the product whenever it's available, so it's not really affecting them as much as it is affecting the competition. And as for inflation, the last time we talked to them, I think it was the beginning of this year, they said that they were not seeing much pressure in prices for the products that they sell, but if there was pressure to be felt, then they will be able to transfer that inflation to consumer prices. That's with regards to the products that they sell. And as for cost inflation, they are seeing increases in costs, and they expect an increase of 200 million due to inflation in logistics, transportation, staff costs. And what they're going to be doing is a very specific plan for cost savings, 300 million, that will allow them to offset the 200 million increase. So I think that in the next results we will clearly see how they're managing the situation. But in any case, I think that they will be, frankly, they will be defended from whatever inflation throws at them. And we also had lots of questions with regards to energy. They're asking us, Carlos and Alfonso are asking, Carlos, with regards to the concentration in the sector, is asking if we see any differences between greater investment forecast in the future and then the position of the big oil, who have been waiting for an increase in investment for the 5 years. And are they seeing something that we, the rest of mortals, cannot see? And then the other question is from Raul. Why aren't we investing in oil? Isn't it maybe because the cheap oil is finished, and if there is an imbalance between offer and demand, why haven't we invested more? Well, do you want to speak? Do you want to take the floor? Well, I think that with regards to the lack of investment in general in the oil sector is something that has been happening for 5 years, as our colleague Juan has already explained. And I think that basically it is due to different reasons, but there is one which is important, which is the whole energy transition thing. And oil companies, when they want to invest, they are always under pressure by their board of directors, as we have seen some examples. They say, well, we don't want to increase investment in this because it's not online with our energy transition plan or the energy transition plans defended by the main markets we're in, by a government in the main markets we're in. That is why that investment has slowed down. And we also know that the cycle of oil companies is generating ups and downs in the market, and they have generated many losses in previous cycles, and that obviously has forced people to invest a bit less in shale oil, for instance, because some people lost money in those investments. But I think that above all, it is mainly linked to energy transition. Now, companies don't invest, and if they don't invest, what happens? Well, when you go to the board with a new project, with a new investment project, or if you go to the bank with a new investment project, you have to go through different risk committees that will say, no, this capital risk is not 7, it's 14. So then the numbers don't add up, and from an energy standpoint, it's not sustainable, and it is not aligned with government's policies. So this leads you to, in the end, finding yourself in a situation where companies don't invest, and they simply invest in energy transition topics. And in the end, if they stop investing, as it's happening right now, prices will start going up, and we will then be in a situation where we say, well, what do we do? What do governments do? It's the energy transition dilemma. You have to have a balanced energy transition plan, because you need to have oil for now and the next few years, and energy transitions cannot be done from one day to the next. They require time. So for all of this, companies need to invest, and governments, sooner or later, when they see these prices, they will have to take part in it. They will have to react and say, well, these investments have to go up. And when companies see some sort of incentive to investment, they will have to do it as well, because otherwise, what do? We don't invest, prices go up. So we're paying for a very high price for energy, and it doesn't make any sense. So especially when we need the energy, and we need it for the next few years, because we don't have a reasonable alternative that could help us in the next few years. So the energy transition is good, but when you have technologies that can allow for that to happen, that are competitive and that can work nowadays, but that does not happen. So we have that need, and that power fight that we have in the sector is also preventing this from happening. And also we have good and bad cycles, and you know that during the bad cycles people decided to stop investing, but we need greater investment, and I think that sooner or later it'll happen.
I also wanted to add something general, which is underlying energy transition, and that also has to do with oil companies and the position that investors have towards the sector. Until 6 or 8 months ago, when we talked about the energy industry, we talked about the energy transition, and that's it. We never talked about security, or we never talked about low costs, because the cost of renewable energies were continuously on the decrease. And we need to bear in mind the changes that have happened recently, and that has shadowed the real cost of things. So at any rate, what's going on right now is that that factor, energy transition, is now complemented with other factors for decision making, which is security, energy security, and affordable energy for everybody, especially for those that are in worse positions, that have very difficult situations in order to face high prices. And of course, we talked, for the two obvious reasons, with companies in the industry, and we see that there's been a sharp change in attitude in the whole industry, not just Exxon and BP, but also smaller companies, politicians. Joe Biden, for instance, was calling upon oil companies to make investments. For instance, which is one of the leaders, one of the key electric companies in France, a couple of years ago, they were unable to sign an LNG supply contract with Americans. As you know, they have a lot and they export it, because the French government prohibited it. They banned it because they have a big stake there. And last week they signed a 20-year contract with the Americans. So the French government has also changed its position, and the new regulation that will come to light in Europe next week will also include gas as an essential power source. So things are changing. Things are changing because we are all realizing how much oil at 110, 120 can make, gas at $130. And it's a great change. And as Juan explained, we're going to be needing gas and oil for the next 30 years. So we need to have affordable and reasonable gas, and we cannot demonize companies that invest. So we could say that the company is a bit obsolete now, because I think the situation has set the stage. I mean, and last year we were already seeing that if investments didn't happen, prices were going to go up, and the Russian situation has just worsened a situation that goes way back. They were asking several questions about gold. Actually, Joan was saying that in such a high inflation environment, are we considering investing in physical gold? And Daniel is asking about Equinox, a company that's very close to gold, is now in the portfolio, but it's a residual position. So the question is, would you think it would be suitable to increase the weight in upcoming months? I'm going to deliver a brief introduction, and then we'll give the floor to Juan Puerta if he can hear us. Yes. We are agnostic in terms of the different companies listed around the globe. We just go for companies that are undervalued as such. It's difficult to say we're going to invest in this or that, unless there's very clear situations like the one that we see now in the energy industry, with an imbalance between supply and demand, as we've seen in gold or copper with Antalya last year. We will invest, and there will emerge options to invest, but it's very difficult to say we are going to place our bets on gold or any kind of material, or like we said about fertilizers 3 years ago. Now all all that market is already explored already. So Juan, would you like to say anything about gold? Well, at the end of the day, the capital cycle, as mentioned, is very important. When you study it thoroughly, as happened to copper with Atalaya, in which we have a very important position, if you study it well, you can analyze that latent unbalance that is indeed materializing between supply and demand, as it's happening with oil and gas. But it's important to say that oil and copper have an industrial use. So if there's going to be changing in demands and you think that economies will continue to develop, there will be a greater demand for energy and for copper, because copper is present everywhere across the board. Gold, off the top of my head, 10% of the total gold demand at the global level comes from industrial use, for jewelry, etc. But the remaining 90% is just for the treasury of central banks or for storage as a deposit. So predicting the direction that gold demand will take is very complicated, because it's a scarce good and there will always be great demand. You could say that, but there could be a period of 3-4 years in which there's a lower demand for gold, and then prices would collapse. So these raw materials which are not industrial are difficult to predict. It's different to silver. Silver is demanded at 60% for industrial use, for engines, for cars, etc. So it's easier to go about that. But for gold, it would be like trying to tell the futures, and that's not our job. So trying to answer your question without being too long-winded, I'd say that if we could find companies in the gold industry, that could be interesting, but because they're very conservative with the price, which is what we found with Equinox, companies that have interesting growth projects that are generating cash flows today, that have no debt, with a management board which is good, and the founder is present in the management board, and they have a track record of having done similarly in the past and having had good results. And we see the price of gold, which is substantially below the current price today, just as it happens with oil. So we don't want to go into divination and to tell in the future, and we don't want to speculate about what could happen to gold. Okay, now going to cheer. There's many questions about this. Alberto, on the one hand, is asking us to clarify the motivation of the different buybacks by the Benedetti family, and he's asking whether these shares which are being bought back will be held in their portfolio or will end up becoming retribution for shareholders. Sergio is asking us about the impact of cause and repair. We also see another question about why we consider that share prices are not taking flight. And they're also asking about the management and whether they have picked up after all the different falls. And from our audience, Cesar was asking about the buyback of shares, and he's asking why they're not cancelled and what will be the catalyzer for the market to recognize the value. We can repeat the questions afterwards, don't worry. Cheer is a holding that has 57% of Jehife, which is auto parts, and an important share in Cobas, which is all homes. They capitalize 500 million approximately, so they have 60% of their capitalization in cash. With regards to the buyback of shares, in these environments in which capital allocation is so difficult in order to grow, given that the prices have been very high in the past few years in the old home in sector, what they normally do is to buy back shares. And the management hasn't been very clear in the past about what they were going to do with these shares that they have bought back, whether they're going to amortize them or use them as an exchange currency for potential M&A operations. But what would be logical would be for them to amortize them. In the past merger of the two holdings that resulted in two Cheer, they did amortize all the shares, but it's not clear whether that's going to happen now. With regards to Orpea, the competitor, which is what the question referred to, by the end of January, there was a book that was published. It was quite hard on the sector, especially focusing on France and Orpea in particular. And they accused the company of prioritizing the profitability of the company over the service that they provide for the elderly at the homes, because they were overpopulating the homes than allowed. Because in order to have 100 people at the homes, you need to have 10 nurses, and this ratio wasn't complied with by Orpea. And actually, they weren't feeding these people as they should have. So when this news were made public, the company experienced a decrease. And what happened in the sector? Coren is being affected here, the other competitor in France. But in Italy, where we have Cobas, this is having an impact. Even though there haven't been news like they have been in France, because there they have recorded a TV show on this even. But there is a great problem in the way nursing homes are managed here and in France and in Italy. We have been discussing with several analysts this subject matter and with several companies, and they report to us that in nursing homes in France, they need to undergo an inspection every 10 years, and only 10% of nursing homes undergo not by regulators, but in Italy, because nursing homes, they need to undergo at least one inspection a year. So there is a difference between the two countries. Then there's another piece of information that can be contrasted. In Orpea, before this, their nursing homes were filled at 100%, but Cos was filled at 70%. And we were wondering why Orpea could be so good, but not Cos. Well, apparently they weren't fulfilling the ratios. They weren't complying with the ratios established by the regulation. But it seems that the problem is limited to France, and we don't think it would extend to Italy. And another question is, what is causing the share price to be on the low end? The thing is that Cheer's value really depends on cost. It's a nursing home. And we must remember that COVID is affecting elderly people the most. And the first place that we saw COVID in Europe was northern Italy, where Cos has most of its nursing homes. So that was the main reason that caused the shares to drop. And another reason is that Sogefi is an auto part company. It was in the process of selling the company. It was in the process of going from a holding company to becoming a nursing home company exclusively. And the automotive industry has had several problems. There's been lack of supplies, lack of chips, and the auto part industry is taking a big hit here. So what was the catalyzer or the trigger, right? The key idea of the management here is to sell Sogefi and become a pure nursing home company. That could be one trigger. And another trigger would be for those nursing homes to be filled, especially in Italy, because in Germany they're doing quite better. And the good news here is that the amount of people that are being admitted into these nursing homes is now back to pre-COVID levels, but the starting point is quite low. And the company is saying that by the end of 2023, we will go back to pre-COVID levels. So we think that as soon as that is confirmed, the market will recognize the value of Cheer. And about the management, I think Rodolfo Benetti is quite a smart individual. He's created Cobas from scratch practically. A couple of years ago, he showed a graph in which he explained how from 6 million EBITDA, he went up to 100 million. We've known him for 12 or 13 years, and throughout those years, he's shown great discipline, especially in terms of capital allocation. Do you want to elaborate anymore? No, I'm okay. Pedro is asking the following question on the circle of competence. We've always talked about investing within the circle of competence. So he's asking, in a more changing world, what is it that we've done to change it, and what sectors and what technologies are included in it now? Well, the importance of the circle of competence is to not leave it, rather than making it big or changing it, is to not leave it, to not invest in cryptocurrencies or things that escape our control. And this is crystal clear. Warren Buffett has always said that the key to be a good investor is to invest in what you know. It's as if you were a real estate expert in Madrid and they ask you, what have you done to expand your skills in New Zealand? Well, I haven't done anything because my expertise is in here. So what we do is to change our focus. Depending on what is more attractive in the market at the different moments, what we do is to try and improve its importance within our circle of competence. I don't think many players in the market know LNG as we do, but after 5 years, of course, you end up talking to all the players in the market. Everybody wants to talk to you, and in that manner, we increase our skills and we increase our circle of competence, and we reestablish our circle of competence in the industry. For instance, in terms of energy, personally, the last time I made a big investment in oil was in the year 2000 when the barrels were at $20 and they got back to 10, and there were several problems that year. So there's moments in which the energy sector is no longer attractive, so our skills become a bit rusty, but now we are back to developing those skills. So fortunately, we are in a segment, a work segment, which is very extensive. Many companies are listed here. We are acquainted with quite a few sectors, and knowing a few of them very well is good enough. We don't need to go into cryptocurrencies or other things. And before they ask us about cryptocurrencies, I'm going to provide my answer, because this is something that goes back to what Juan said. Of course, we normally invest in companies that are discounted, but the same applies here as applies to gold. Now, we are not going to expand our circle of competence trying to tell the future for cryptocurrencies. It would be terrible, because we would increase in our circle of incompetence, because we don't know how much this could be worth. There's no objective value, no fair value to be discerned here, because we don't know what the use of this is. So the key to the circle of competence is to be very careful to not leave it, not leave your circle of competence, and expand it slowly. You have already answered questions about cryptocurrencies, especially given the decreases that they're undergoing right now. Yes, there's been big falls for some companies recently, and I'd like to mention that there's one of the books that we published in the past, and we explained that something can decrease 90%, and it can decrease 90% again. It can go from 10 to 1, and then once again experience the same type of fall. We're going to be talking about banks now. There are several questions that actually point at the fact that some other value investors have started invested in banks. So they're asking what we're going to do in Cobas. Okay, maybe I can provide a general answer, and then Juan will give a more nuanced answer. We have a Spanish company that's listed at 100, and its value is 235. In order to buy a bank here in Spain, it should be the hyperbank, because if it's more than double its value, I mean, companies that we've all known for years and years on end, we must remember what we did in 2020, selling banks to buy Sol Meliá. So we'd rather have something in our hands that is more tangible rather than banks. The first reason is that we have a very good portfolio in Spain, and of course we're not going to invest in Wells Fargo or an American or Chinese bank. We have an exceptional portfolio in Spain, so it wouldn't make any sort of sense to invest in banks from this philosophical perspective in our portfolio. And I don't know, maybe you want to provide a more nuanced answer. Yes, when you invest in banks, you need to bear in mind all the different scenarios. And if you compare all the scenarios to scenarios for other industrial service companies, it's really not that attractive. And there's also a qualitative part, which is that this type of industrial and service companies, for these ones, ultimately, the shareholder is in charge in the cases in which we invest, to say the least. But it's not the case for banks. And in the context of coronavirus, it has become very evident. There were profits and they couldn't pay them out, and shares were at historical minimums and they couldn't buy them back, without even talking about the operational business in which shareholders cannot really decide who money is loaned to, that type of thing. So with the different scenarios that we consider possible, well, in the beginning of the presentation, we talked about massive investments of money, public expenditure that was massive, and that is not sustainable in the long run. So if most scenarios are not positive, what to say? Of course, if the result was positive in all scenarios, banks would be a good investment. But if they're at 6 or 7 times profit without indebtedness, where are banks? Are at 8 times asset over equities. So the leverage is almost 20 times. In the Iberian portfolio, I don't think we are even at 1 net debt EBITDA. So the potentials are similar and the risks are much lower, and this is why Cobas doesn't invest in banks. Just to elaborate on the answer, at the end of the day, there will be a positive environment, there will be a rate increase, a rate hike, and this rate hike will hurt many lenders and many people who are indebted, companies too, and many borrowers, rather. And this is why we said we sold Metro Bacesa. We'd rather sleep better at night. So if things go well and nothing happens and there's no recession, then fine. But, it'll go well with the companies that we have in our portfolio and with banks too. But if things go bad, then banks will suffer. We have received several questions about Golar. We tried to group them up, and Samuel was asking us at what price we would settle our position. Juan is also asking whether we bought more shares in the last quarters just because there's no better investment alternatives, or because there is an increase or an improvement in the enhancement. They said that we have bought more Golar shares. That's what you mentioned? Yes, they were asking whether we have bought more Golar shares in the last quarters. That's the question. Because there weren't better alternatives, or because of the uncertainties coming from the Russian situation. And David is asking us for how long we will keep Golar in our portfolio. Well, I haven't brought my crystal ball, but let me answer, Juan, actually, because I was checking Golar before I came, and we had $10 million in $10 million invested, and now we are at $6 million. Golar is not the same at $5. than $20. So to get financing, we had to sell. And the same happened in Cosmos. It was a larger investment in oil. It used to be at 1 and now it's at 6, 7. And it's been through it. It's been at 8 too. So we had 20 million in shares and now we have 6. We have sold 75% of our position. This goes back to how value is generated. You can sell things that are experiencing a very important hike, coming close to a real value, to buy things that are lagging behind. For instance, Cosmos, we have sold 3/4 of our position to buy some of the companies that you saw before, which have behaved worse than Cosmos. So in the sector, we decrease the risk and we look for the same potential. We don't necessarily need to go to other sectors. So we haven't increased our position in Goller. We have decreased our position. You know that we sell things when they go up and we buy when they go down. Sometimes we get it wrong and sometimes we don't. But this is what we do because it's a probability game. With when things go up, possibly this will have a reflection on price. And when things go down, it's possibly that the price will also suck the impact. So Goller has great potential, even more so now with everything that has happened, because they have floating liquefaction technologies that allows to extract gas anywhere in the world from any ocean. And there's a lot of gas, and they're the only ones that have had a fully functional boat for 3 years in Cameroon. The Malayans have a couple of them, but they have had some problems, and Shell has one, and it's been a total disaster. And now it's working, but it has been at the standstill for a very long time. So they have a technology which is not that easy. They are the ones that have it best, and everybody's knocking on their door so that they can develop the company across the board. So this goes back to what we mentioned before. They are on the right track. Very good things are going to happen. There's a very good chance that this will happen, and we'll try to make the best of those probabilities. And the more this increases, the better. So we need to see at what point we need to sell to buffer the risk, to buy things that are lagging behind. It's the usual game. And Goller is a company that, if everything goes well, we could be their shareholders for 10 more years because they have such potential to do things. And if everything works out well, we will be shareholders for 5 more years because the market won't pick up. It's like Elecnor. They were our greatest investment in the Spanish fund. And we thought that we were going to be there for 25 years. And in 25 years, still the market hasn't recognized its value with a great patience.
Well, Manuel Luis is asking for forecasts. He's saying that after difficult years, it seems that we're doing things reasonably well in our funds, although these are intermediate results if we compare us with other fund managers and some that are doing worse than we are. And will we ever manage to get closer in the next months, years to those that are doing better with regards to results? And then on the other hand, we have a question that, there have been a few questions related to this with regards to the 5 years that we have been working with our funds where we have these profitabilities or this performance that hasn't grown and other value managers have done it well. Do we think that there is more to be gotten from our funds? I know that you're going to highlight this. Actually, we are repeating things that we have already said, but to be honest, our funds are 225 to 135 and they're going up, and these figures should still go up. So we're getting closer to that, and we will do it. That's what we will do. We will get as close as we can. I don't know if we will do it better or worse. That's not under our control. We are at 225 and then 230 and 35, and that's what we'll do. We'll get that number and go upwards, and we've always done it. We are being asked about the tobacco sector. Daniel is asking why we purchase British American tobacco and not Altria, when Altria is cheaper, has more quality and more free optionality, according to him. And what do we think about the repurchasing program when it's most expensive and instead of benefiting from its drop? Well, We were looking at all the companies in the sector at the time, and we decided to choose British American Tobacco for different reasons. The first one is because it was cheaper, and I think that it is still cheaper, and I think that it is around per 10, 11. It's per 8 at British American Tobacco, and the other one is at around 10, 11. So we're doing it very well, and we have been selling some stock because they had a very good performance. That's the first thing. And now as for quality, well, I think that both have a group of brands that are very good. It's true that Altria has Marlboro, which is number one, the world's number one, but British American Tobacco is more diversified. It's more diversified from a geographical standpoint as well. As for new products, they both have a very good portfolio. I think that the question was something about the optionality. Is that true? Yes, free optionality. I think that he's referring to the participation that Altria has in YOL. And I think that in that sense that it wasn't very successful because British American Tobacco is actually having better results. But both have very good options. It could have been the one or the other, but we decided to choose British American Tobacco for those reasons. And as for the buyback, it's true that they have started now. The shares are going up. The stock is going up, but that's due to the fact that they purchased in 2017 the part that they didn't have in the Americas. And from that transaction, they had lots of debt. And until that debt did not go down, and they had a debt level that was a bit more acceptable, they did not start the buyback. That is why. And with regards to the pharma sector, maybe Vicente? They are asking us about Teva and Beatrix, the current situation of both companies. And then there is another question regarding Refalls about what their forecast is. Okay, well, let's start maybe with the two first one, which are more similar, Beatrix and Teva. They're two pharma companies, global pharma, with over-the-counter and brand products, and we have 2% of both their portfolios. They have 3-4 times over profits, and a pharma that has that value is very interesting. Obviously, I'm guessing that you also want to know why they didn't do it well and what the forecast is. Well, with regards to Teva, basically we invested because it is a company that when the new CEO Caritrul, we studied what their history was, what their past was, and we saw that he had worked for Novo Nordisk and then he worked for Lundbeck, and we asked for third-party references to know what his performance had been in these companies, and the references were always golden. So that actually seemed attractive, so we decided to be a part of the company. And getting into a company where the situation is complicated, I think it was in 2007, 2008, with a debt level of around 34 billion. And in these years, what they have done, this new CEO has reduced the debt. We expect next year it'll be half what it was, so 17 billion, and focus on paying debt because it is a company that comes from having made acquisitions with a different management that were very aggressive acquisitions, and the debt went up. So this new management had to solve the problems that they inherited by purchasing the debt, reducing costs, and trying to find new channels for growth. And actually this company, this over-the-counter company, also has some brands, and the main brand that they have is going to expire in the next few years, which is Copaxone. So they saw a decline in sales, and they were facing all of these challenges at the same time. But he's organized, he's put some order in the house. He has reduced debt and costs, and now he needs to show some growth, and it will come from biosimilars. I think that Unida is the most important one. Umida is the most important one. It's a market that represents 20 billion, and they expect to launch it next year. There will be other players for sure, but there will be an important part of the pie reserved for Teva. And they have other 12 biosimilars that they will launch the next few years, and some innovating products such as Peridone for schizophrenia, and this will allow a company that was in decline to have very good results. They will have a tipping point in the next few years, and then we will see it go upwards. So we like the management, and this is a pharma company that has 3-4 times profit. It's true that the debt was higher than expected, but with a forecast of normalizing the debt level, it will be at around 3 times, and we think that they have very good forecast. And Beatrix, well, is the same situation more or less. It's a company that has a 3 times profit in their stock, and here at the beginning of the year they announced that there would be a disinvestment of biosimilars, and they want to focus on brand products that are a bit more long-lasting duration. I think it represents 20% more or less. So we did what we usually do. We thought about it, we reviewed our models, we looked at the different possible scenarios. We wanted to be critical when needed and thinking about whether we needed to make any decision. And when we saw that the shares were going down 20%, the stock went going down, and they were selling the biosimilars for 7 billion, we thought that people maybe might not want to see these companies sell a part that was growing. But now that we look at the stock and the disinvestment that they're doing, we think it's quite reasonable. So what are they going to do with that money once they close the operation? Well, they announced a plan to repurchase shares, to buy back your shares when you have benefits, when you have profit. Is the best investment you can do for your shareholders. So in that sense, we thought that they were doing the right thing. And the third company was Grifols. But what was the question? What's their future? What's their forecast? I think that we have to explain that in Grifols you have 3 different variables that are important. Probably the first one is the business evolution, the daily business evolution. They produce plasma proteins. They get the plasma that is donated the world over. They transform it, and they create plasma proteins for chronic diseases, immunitary diseases, and coagulation factor diseases. When you have a coagulation deficit, for instance, and I think that what happened with this company and why they did it wrong during this time is that we have COVID. And they didn't have good results during this time because there was COVID and people stopped donating in the center. So their main raw material to produce these plasmatic proteins was no longer there. It didn't exist. So they had to reduce their volumes in order to be able to sell. And since there were no new donors, they had to incentivize that the donations so that people could come to these donation centers because people are being paid for those donations. So they had less volumes and more costs. So obviously the EBITDA went down, and that is what happened during these last few years. But it is all linked to COVID, and this cyclic part of the business, which is linked to COVID, we think that once this is normalized, it should pick up pace and improve. And the last communique done by the company, the plasma collection was starting to see some improvement, 15 to 16% growth. So if that becomes normal, we will go to back to a normal situation where they have 20% EBITDA margin, and they should have margins of 27-28%. So that is 40% more. And that is one of the pillars. And the other pillar is the fact that they had debt. I'm sure that this investor also wanted to know about their debt. Well, they have a bit more debt than what we expected, and that is why they have an exposure in our Iberian portfolio of 1.5. But if they normalize this cyclic effect of COVID, we think that the company should be able to make the best of it and have a better result. And then there is something else, which is for 2023. We have another company which has a very interesting potential for growth in an oligopolistic market, but there are other competitors that are producing alternatives for the diseases they work on. So we have to always be cautious, and we need to look at the evolution and to assign odds to it, because in the end that can also change your business case. So we have to consider all of these points, and with the recovery of plasma collections, we should see an increase of growth, and we should go back to the margins that we had in the previous years, and their financial structure should become a bit more normal. And as for the alternatives or competitors, well, we have to look at it, and obviously that is our day-to-day work. That's what we do. We look at things, we study other competitors, other threats, but also other opportunities and so on. And we have to think about it, the probability, the odds, and that's what we do. they're asking the following. Don't you think that a company with so much risk, with low margins such as Técnicas Reunidas, with so many tenders, should have a lighter weight in our Iberian fund? Juan, would you like to answer the question? Yes, I'll answer the question. The risk of tenders and low margins. Well, I think that Técnicas Reunidas is a company that's exposed to a sector where there is risk. These are engineering projects that last 4 years. They're very complex. Creating a petrochemical plant or a refinery, it's hundreds of millions, and there's always risks in these projects and in these sectors, these business sectors. But we think that Técnicas Reunidas is probably one of the companies that is most conservative and that better manages risk in the center. And I'm not talking about Europe, but worldwide. And it's not just us who think this, thanks to the analysis that we have carried out, but it is an opinion that is actually shared amongst the competition as well. They always say the best things about this company, and always people have a very high opinion of Técnicas Reunidas. And if you talk to former employees, they talk to you about what goes on in the company and how rigorous they are and how well they manage risk in the company. And we think that Técnicas Reunidas within the sector is very good at managing risks. And it's true that they have low margins because this is a cyclical sector. And they have been in a very low cycle where less investment was being done, and the clients of Clínicas Reunidas, such as Saudi Arabia or United Arab Emirates, have gone through a situation where the oil price was very low, so their P&L was low and their cash flow generation had gone down as well. That started in 2014 with the war between OPEC and Shell to see who could produce more, and the prices of oil went down. Then they recovered a bit in 2018, 2019, and then there was COVID that hit. So it seems like these are pretexts and excuses, but really this is what they went through. And the reference price in the US was actually at minus $30 in April 2020. So obviously this had an impact in Técnicas Reunidas that stopped investing in the projects they were investing in, have decided to reduce costs. They have changed their way of paying, and that obviously has put much pressure on the suppliers. So obviously Técnicas is the good thing about Técnicas is that they have a family backing them up, because many of the competitors for Técnicas Reunidas have been increasing capital, so they have more shareholders. For instance, Petrofac has seen an increase of capital at a bad moment. And now they have recovered their stock, but that is a company that did not really have such an important weight, and Técnicas Reunidas has the support of the founders, and they have been able to escape that situation. They have found an intermediate solution with financing by the SEPI. They called it rescuing the company, but it wasn't really. The government has decided to invest in the company with European funds. And we think that the low margins and the risk are included in the business. I think that the low margins derive from the cycle of the business, and we really think that we now will see a cycle where things will go up and the family knows how to do things. Clients trust in them, and I'm sure that they're getting many tenders, they're being awarded many projects, and we think that the situation is going to turn. And as soon as the market sees that the margins go up and that revenue goes up, then the stock price will also go up. Thank you so much, Juan. And Agustin is asking if some unforeseen element were to happen and Mr. Parames asked you to, and Mr. Parames could not manage the funds, could somebody else do it? Because investing with you means assuming this management risk. Yes, obviously. I mean, what we're developing and have been developing for 2-3 years is a teamwork. It's teamwork. Decisions are taken jointly. And if I disappear, there will be a smaller team, but you shouldn't really see a decrease in quality. It could even be better. I just want to remind you that I was responsible for doing a wrong investment that had us lose 15% of the investment. So we would have avoided that if I weren't there. So we don't know how things are going to unfold. We don't know how it will result if I'm not there. But what we are betting for is for a collegiate decision-making process. And in the long term, it will take us to go from author managers to, I don't know how they will call it, but it will be a normal managing system with a team managing the funds, because that's what we're doing. That's what we're trying out. That's what we're testing, and it works very, very well. It works very, very well, and the decisions that are being made are wonderful. So, for instance, the money of my family is there. I mean, if I'm not there, my family will keep their money there. They will keep the money in these funds that will be managed by our managing team, because this team is actually ideal. I know that now the team is very, very reduced, but there is much cohesion and they work very, very well. We have worked very well for 5 years and then 2 previous years. So actually, I think that, yes, obviously, it's something that could worry you if it happens to me. I mean, if I'm the one to suffer some sort of accident, but it shouldn't be a problem, really. It shouldn't be. That's the final objective, isn't it? For everyone to be able to have some sort of sustainability. And I think that we're on the right path for that.
I'd like to share an anecdote that happened a couple of weeks ago or even a month ago. We heard about news on a company. Vicente and myself, we were saying this is very good news because they're not going up. Why don't we introduce them in the fund? And we were drafting the email to send it to Paco, and Paco just sent the order exactly as we were thinking of it. So we have been working hand in hand with Paco for many years, and we have the same train of thought as to how to sell, when to buy. We have some discussions with regards to weights, whether they should be higher or lower, but generally I think we have the same feel to it. Yes, as I mentioned before, next week we're going to have a meeting to decide whether some new companies may join the fund, and I think there will be no big discrepancies, and possibly all of them will join at some point. We don't know when or how, but most of them will probably be accepted. Why? Because we all know what we're looking for, and we do some previous work, and we're all quite homogeneous within diversity, and we know where we are. We're on the same wavelength. They're asking us whether we are thinking of creating a product focused on ESG because of the different movements that they've been in funds in the market. Well, we have 45% in energy companies. Well, I think we wouldn't be able to pass any screenings. I mean, the concept of ESG is something that is known to us. I've been investing for 30 years, and ESG is essential. We invest in companies that don't harm anyone or the environment. We won't invest in anyone that treats their employees badly. We want to have a decent corporate government. We want to invest in family-owned companies, as you're seeing too. So by definition, that's what we think you should invest in. But if, in accordance with your ideology, you decide to invest in this and that, well, of course, that can happen, and you can focus purely on energy transition for 2 or 3 years, and this has caused the oil to go up to 110 and to scarcity in gas. I mean, who is right? Who isn't? I mean, inputting your ideology into funds is complicated. We want to separate it. We'd rather separate it, and this is why we have 2 fund managers. 2 fund management companies, one with an ideology that considers that profit isn't everything, and you know it. And if you invest in those type of impact funds, you know that there's a balance that needs to be struck there.
And of course, in the other fund management company, we just invest into projects that we consider attractive, abiding by the law, of course. And we have many questions on the real estate. They were mentioning that in the 80s, with rates at 50%, a household was worth 3 cars. And now with rates at 0, they're worth 10 cars. So they were asking whether if a rate hike happens, the real estate market could reevaluate at a lower point than inflation. And they were asking us whether the situation could give rise to a decrease in real estate prices in Spain. And they were also asking us about what is our forecast for the residential and real estate markets in the short run and long run. Well, the same happens as with cars. From the relative perspective, they're worth more. They cost more. In the real estate sector, of course, inflation plays a role, but it depends on supply, demand, and the cycles. And if there's a decrease in demand because rates are too high, in reality, a mortgage at 1% could be, 400 euros at the monthly payment, and if it goes up to 3% or 4, your installment would be at 500 euros. I'm not making the math here. I'm not doing the math, but this could result in an issue in demand, a problem in demand, and oil is also going up. So there could be a problem in demand. So irrespective of inflation in the real estate industry, as would happen with any asset that you own, they're subject to cycles, to supply and demand, and they all have their own particularities. And if coming from such big price increases at a point in time, this could decrease demand, even though this is a very cyclical sector too. I mean, everything's possible, and frankly, we have decided to reduce our exposure. And you need to consider why. It's like anything in life. I mean, there's no need to invest in anything. You just invest in it if you think it's quite clear. And the best moment to invest in real estate sector is when no one's buying. Right now, people apparently are trying to buy flats to rent them out. And I think we need to take a step back here. Can I add to the question? Because I think that in the automotive industry, there's been a deflation, something which is unprecedented. Now cars are more affordable. 60 years ago, you needed to have more salaries to pay a car than what you would need right now. But in the real estate, this hasn't happened. So comparing cars and the real estate sector, I don't think it's fair. They're asking us about Babcock. In particular, Andres would like to know how the investment thesis has evolved. Babcock. They're asking about Babcock. They want to know how the investment thesis has evolved now that there are no COVID restrictions in the United Kingdom, and with the Russia and Ukraine conflict, defense budgets should increase, right? That's a theory, but it seems that shares are not evolving accordingly. So he's wondering whether something is going unnoticed to us. And Manuel is asking us what's the risk behind this investment thesis. With regards to what are we missing? Well, that's difficult to answer. But the truth is that we know about Babcock because you mentioned Ukraine, you mentioned COVID, and those are two key topics here. Because Babcock, what they do is to provide maintenance services for the military and for nuclear boats. And how do you benefit from that? Well, giving more savings to the UK government and the government itself would good. And that's, of course, split between the taxpayers and the shareholders of the company. If COVID causes an impact, well, you cannot have that many people working at the same time. You're not as efficient because of COVID. You get
fewer savings. If there's fewer savings, there's not that much money to give out, and that results into fewer profits, and then the shares have taken a hit. And of course, the effects of COVID will not remain forever. We will overcome the situation, and the assets that are being held, they will last for decades. So it's a good investment. It's a good investment opportunity. So why isn't it going up? Well, that's a doubt that we have with regards to Babcock and any other companies too. As for the Ukraine war, we must bear in mind that they are just maintaining assets. And we need to have assets, of course, in order to maintain them. But there are projects to build new boats. Actually, a new contract was signed after before the Ukraine war with Poland, also a contract with Indonesia. Talking about Babcock, we also have participation stake in Australia. They're very concerned about the geopolitical threat coming from China. But something that is important is that it's trading below its normal profit yielding capacities. That's essential. I don't know if I missed on any of your points. No, I just want to add that the UK government had funded 3 boats with the Babcock technology that were sold to Ukraine before the war, by the way. But right now they're not in a good condition to go about it. But Babcock is not just in the UK, they're also in Korea, Australia, etc. Automotive industry. Juan, before you talked about the comparison, right, between the real estate sector and the automotive industry. But they're asking us now about the future of the industry, and they're asking us whether companies that manufacture chips or semiconductors could be interesting investments. And Jaime and David also mentioned Hyundai, Renault, and what our position is given the situation in Ukraine. We have some questions on Tesla. Every single year we receive a question on Tesla. In particular, they're asking us what we think about the current situation of the company. Right now, they have 4.5 times more margin per vehicle than General Motors. And they're also asking us whether we intend to increase our exposure towards the sector. And Rafael is asking us about Tia and Gestamp, which have been recently introduced in the Spanish portfolio, in the Iberian portfolio rather. Paco, should I start? Yes, there's many questions. Let me take it step by step. It's no secret that it's a very complex sector. We've never tried to share a different opinion, and of course there's been very important situations, combustion engines replaced by electric vehicles and self-driving vehicles. I mean, this industry is undergoing constant changes, and we need to see what companies adapt better to that change process or fail to. As Paco mentioned before, we have reduced our exposure, and part of the cyclical reductions are due to the fact that we have sold some automotive industry. Porsche and Hyundai, when they saw great increases, we reduced them. BMW, we were at 1%. We also left the company when they got very close to our target price. And now there is a marginal position in Hyundai and some with Renault. I think it's about 2% in the international portfolio due to a reason that I'm about to explain, which is very specific to Renault and not so specific to the automotive industry. And about semiconductors, we go back to what we mentioned before. We should possibly be honest with ourselves. Semiconductors are outside of our circle of competence. It is not a super technological industry, but it is an industry that we have historically devoted little time to. It's based chiefly in Asia, China, Taiwan, South Korea, and we have some exposure to semiconductors through Samsung. if I'm not mistaken. But at the end of the day, it's a complex sector. It's highly cyclical, and there's a very high demand right now, exceeding supply, and prices have gone up. But right before COVID, there was excess supply compared to demand, and it was very punished. The sector was taking a hit. But in this sense, we don't want to be out of our comfort zone, and semiconductors, I think, are outside of our circle of competence. Now, about Renault in particular, because it has been mentioned in the question. Hyundai, well, my colleague Miku is really on top of that, and they're doing things very well. It's a very undervalued company with good margins, undergoing a growth and improvement process, and they're exposed to hydrogen trucks and electric vehicles. So we are quite reassured with our position. There is a potential revaluation. And Renault, quite honestly, they have undergone a restructuring plan, which we consider that has been successful. Not that long ago, I went to Marbella and I tried the different electric vehicles that they offer, comparing them to Teslas and Volkswagens and Hyundais precisely. And I think they're very competitive. They're very good in electric vehicles. Very simply, to not elaborate too much, they are 6 billion euros in the stock market right now, and if they were going to sell tomorrow their stakes in Nissan at market value, not the value that we think they have, is 8 billion. So they would cover their stock market value, and they would have 2 billion surplus. And then we also need to consider the value that Renault has. They're very good in electric vehicles. They have the famous Zoe, and they have a captive financial company that could be worth 6 or 7 billion if it were traded. So we think it's undervalued. This is why we have exposure to the company, and we think that it's going in the right direction because of the management company. And to wrap up, Tesla. We are not invested in Tesla because of a simple manner. They are 800 billion in stock market value. What would be the multiple for this company in 5 years' time? 20 being generous, because automotive companies are not listed at 20 times, a multiple of 20 times. So in order to justify those 800 billion of capitalization, they would have to be making 40 billion. Last year's they made 6 billion. So they would have to multiply by 6 their profit in the next 5 years. If they manage to multiply their profit by 7 in the next 5 years, that would involve multiplying their sales by 10, selling 10 million euros instead of 1 million euros, 10 million cars instead of 1 million, and they would create those 40 billion in profit, and that would justify their current stock market value. So the revaluation potential would be 0, and we don't want to set a price for the future, but as was mentioned before by Paco, odds would be against us. I mean, if a company that needs to achieve so many things, and we yet need to see whether they will succeed to justify their current value, there's no potential revaluation for them. So odds would be against us. We're not saying that it's a bad company. We're just saying that it's not a good investment. You need to tell apart good companies from good investments. They're most times not the same, and that is my answer about Tesla. And again, I am not an expert. We are not invested in Tesla, but we follow it.
Well, in any case, answering to this gentleman's question, Tesla's margins are very high because the price of the product is also very high, and in the end we're talking about a luxury product. So comparing it with Renault, I mean, you cannot compare it with Renault. You would have to compare it with Ferrari or Porsche or BMW at least. You have to compare it with other luxury products which have very good margins. Tesla is still a luxury product. We have also received a few questions about Arista. Jose Ramon says that considering the history of the fund with this company and the bad results, wouldn't it be advisable to understand that it was a mistake and try and find profitability somewhere else in order not to make this mistake a more serious one? Shouldn't we maybe think of changing? And then Carlos was asking, why do we still invest in Arista if the results are not good? Well, actually, no, the results are improving, and you could say something about it if you want, Carlos, because since I'm responsible for this mistake, I shouldn't be the one. Well, I mean, in Arista, I said it last year and the year before that. In Arista, I said that the fault was mine, but it's just one company like any other in the portfolio. Last year they had an increase of it went from 0.80 to 140 in their stock. So 140 is how we sold the last ones, and it went from 10% to 5% of the company, and that's the position we currently hold. 5% of the company. We have purchased one because it is at 0.85, 0.90. It has gone from 140 to 0.90. It's not the same thing if a company is worth 1.4 billion or 800 million. So it's not that I love this company, I will buy it at any price like they do with some technological companies. No, investing is assigning value to things, and when there is a discount, you purchase, and then when there isn't a discount, you sell. And that is what we have done, and what we have done with Arista. And now we have 3% of Arista. And if it goes to 140 and the rest of the portfolio is at the same price, then we'll do what we said previously. We will sell as fast as we can, and not because of any reasons, but because we have other better options. And if Arista still keeps on dropping, then we will still be in Arista because we think it is worth more than that. So what I do not accept is that the company is not having good results, because that's not true. The company is doing quite well in the whole restructuring that we contributed to, with everything that we did, and with the management team and the board of directors is actually going very well, and they are a very good year. I mean, maybe not the fiscal year, but then one that starts in July or August, they got 15% margin, which is what they wanted to achieve. And we will be talking about 150 million free cash flow. And well, right now it has a value of 850 million. Well, 800 because it's Swiss francs. So 6-7 free cash flow. It's very stable, and it's interesting. Actually, it's interesting what we said previously. They are managing to have increases in prices, very important increases in prices, to transfer the cost of cereals and so on to companies such as Aldi, Lidl, and others that are very, very tough clients when in the negotiation process, as everyone knows, and they're managing to do it, and they have a plan that allows them to maintain their margin. So I think that it is a company just like any other, but things are going well, and we just benefit from the moment in the market. If it goes up, we'll sell. If it goes down, we won't. It's as always. I think I've already answered the question. I think it's clear enough. Yes. Okay, so we have many other operational questions that have to do with, for instance, the periodical payments to investment funds. And as you said at the beginning of the conference, with a new private area that we hope to launch in the next few months, people will be able to be doing those periodical payments. And then there are other questions about the changing class and the profitability on the performance that we had at the beginning that will also be monitored with the platform. It is something that will allow us to see the performance from the beginning. Then there are some questions with regards to the reimbursement commission, 4%. If we always get that paid, it's only during the first year of tenure of whatever shares have been purchased, and if we can invest in Cobas when you do not live in Spain, because we have some investors outside of Spain. And then some questions with regards to the pension plan. What sort of portfolio is it, and does it replicate the selection, or are there some differences? No, it's a replica of a Cobas Selección. It's exactly the same. Okay, so Geray is asking us the following question. He's saying that many months ago, many experts and gurus of the investment world have been saying that the stock exchange was going to fall worldwide. So what is our opinion in that sense? And are Cobas's funds protected for such a situation? And based on which criteria? No, we're not protected from gurus, not at all. They can attack at any point in time. No, I'm sorry, but there's nothing for me to say. I have no idea what the stock exchange is going to do. Sophia, with regards to the decrease in commissions that we have put in place, and she's asking, when will the commissions go down once again? Well, it's with Series A. Class A, which is a good class for those of us who have been investors for 7 years, will be launched in 2 years, which is the calendar that was said last year. So it will go down to 1%. I know it's a bit complicated to understand how it has been done, but it's also that we can decrease the commission. And I know it's a bit complicated, but you have to understand that the evolution of each class or each series follows a certain criteria. It's a bit confusing, but it's the only way of doing it. But in any case, if you have any doubts, just call us, call the department, our department, and we will try and solve whatever question you have. Jorge is asking about Vocento and is asking when the increase will come about. When will the increase in Vocento will come about, and do you see any potential in it going up? Tomorrow. There is an annex to Vocento. I have to, before I answer this question, I would like you to look at the history, the last 10 years history. Here we have a slide for Vocento, as you can see. Wait. The light gray line are Vocento's revenues that went from 700 million to 150. And this obviously has been due to the change in the sector, less sales of paper, newspapers, and publicity going down. But what did Vocento do? The green bars that you can see below are the operational results, the EBITDA. And as you can see, more or less, it's been maintained. It's been stable. Obviously, with 2020, it was a bit worse due to COVID, but more or less, it's around 40 million euros every year, despite that fall in return. And that's because they have a very good management team that has managed to offset the drop in returns with reduction of costs. And the black line is debt. That's the net debt. It has gone from 120 million euros to last year 2 million euros, so almost zero. And Vocento is not as bad a company as people think it is. It is actually a very good company. And now talking about its future. Why do we have Vocento? Well, because Vocento is not just newspapers. I don't know how many of you connected here today or present in the room know that Vocento owns 50% of the number 2 company for online ads for cars. It's also number 3. It owns the number 3 company for real estate ads and the number 1 in the Basque Country. So this business, this online ads business, is a very good business. We have to remember that in 2020, Ecotec, which is a prestigious fund, purchased Idealista, and they paid 35 times EBITDA. But what's obvious is that the car sector has been penalized by what Juan has already mentioned. When that passes, the profitability of this business will come back. But not just do they have the ad business, they also have a cuisine business. They also have a radio business, true. I can't find the word. Publicity agencies, and so those are all little businesses, but they all add up. And the addition of the value of all of these businesses is what makes this value, the stock exchange value of Vocento. And then we also have the newspapers. And I also wanted to ask a question. Do you think that the need of being well informed has been reduced? It's true that paper as a support as a media is seeing a decrease in its strength, and it's true in 5-10 years time paper will disappear. But for that to happen, the company and the whole sector needs to transition towards digital, and that has 2 very positive effects. The first one, you better identify your audience, and thus you sell your advertisement better. And secondly, you can save costs in distribution. Your subscribers, your online subscribers, well, the online subscribers are growing on a yearly basis. This is also a strategy that has been followed by El País, and there are more digital newspapers every year. And there's something important that we need to understand. In the last few years, at the beginning of last year, almost all of the important newspapers' webs would have you pay to read the news. That was not something that could happen previously, but now all newspaper websites are having you pay to get access to their news, and they're getting very good results. And I think that due to all of these things, there is much to be expected from Vocento. And it's not just us. The consensus of the market with regards to objective price is 190, and the stock price of the company is around €1. So I think that there is much to be done in Vocento. But you haven't said when it's going to go up. No, I'm sorry, I don't have a crystal ball. I cannot answer that question. Well, we have been here for 2 hours and 45 minutes, so we are going to try and be as synthetic as we can to try and answer as many as we can. TK Corp and TK LNG. For LNG, could we please say what the reason has been? It's true, we haven't said it. It's interesting. TK LNG, we have been there as shareholders for 4 years, and well, there was a takeover bid, and it was not the objective price, and we were forced to go to the takeover bid without being capable of doing anything. And the same thing happened with Work, which is also an LNG company at the beginning of the year. So, well, we had to sell the shares, and we have gotten money out of it, out of the investment in the midterm. It's 25-30% in 3 years, not a big amount, but it was not what we expected, but we had to sell. And the reality is that thanks to the investment in TK, we have managed to get to know other companies in the sector that are allowing us to offset that lesser performance that we obtain in TK, and we now know the sector very well, which we have been saying during this conference. So it was not the perfect investment, but it was useful for other things. And right now, in our exposition to TK Corp is the mother company, and we have 2% of the company. And TK Corp right now has treasury. It is worth 300 million in the stock exchange, and it has 290. Those are the results in their current account. So actually, they have TK Tankers, which is a subsidiary, which are oil tankers that are average to high. So they're the big ones. So it's like 300,000 tons, and then Suezbanks is an alpha tanker. So they're in that niche, and they're doing very well because they are all going towards those tankers. But it's not an excessively attractive investment for us. It does not have as much potential as the rest of the portfolio. So in the mid to long term, we will have to take it out of our portfolio. But in any case, it is an investment for us. But we obviously have less exposure than we used to have in these last years.
To wrap up, Ruben is asking us, what leader or financial personality do you admire, and why? You should have given me this this question beforehand. Well, I don't know I don't like to read questions in advance, but what can I say? I mean, in the financial industry, of course, Warren Buffett has helped us out with his contribution for many years. Right now, well, he's perhaps a bit more trying, but in previous years and throughout history, he's been a reference at least for me. What about you? What would you say? Well, I'd say talent wins games, but the team wins championships. And I'd stick to that. Maybe we could talk about something more general. We've been talking about inflation, potential recession due to that inflation too. And they're asking us how to defend ourselves from that. What is the best alternative here? Well, frankly, I wrote a book in which I said something. And if you don't understand anything in a book, just get this takeaway. Invest in real assets. It's the best way to preserve your savings. Own things, whatever it may be. Desks, tables, shares, homes. Become an owner, an asset owner. That is the best way to fend inflation. Historically, this is what's happened in Germany when they had an inflation of 1,000,000% a day. Then the stock market went up 1,000,000% every day. I mean, assets are linked to inflation, just inflation, perfectly. But something that we need to care for is treasury. Paco, if you only managed your own wealth, your families and your friends, and you didn't have the restrictions that our management funds pose, what would be the minimum number of positions that you would have in your portfolio that would allow you to sleep at night? Because I explained this in my book. Again, the first thing I did when I started investment was to put 70% of my investment into Nissan, and I lost 80% of my money. And since that day, as I explained in the book, I tried to diversify, and this sector forces us to diversify, because it's not that we were super smart and we saw the super opportunities there. So I think it's better to diversify the rules of the funds, to invest a certain percentage into certain values. I think it's the best way to go. And if at some point in time there's something that is extraordinarily positive, as we've done in the concentrated fund throughout history, you would have put 50% of your portfolio there. If you see it very clear, as we did with Goller in the concentrated fund a year and a half ago, 18% of the concentrated fund was put into this, but not any longer. It's for exceptional cases when you are very certain about what you have in mind or in your hands. They're also asking us about the 3 pieces of advice that you would give an investor, even if it's a beginner or someone who's already experienced. What is it that they have to do to get profitability out of the wealth that they generate? Well, if you're beginning, well, you're talking about someone who wants to invest on their own. Thrifty investor, what advice would you give them so that they can get profitability out of their wealth? Well, do what I did. Look at people who have been successful in investing and try to do something similar. I mean, there's nothing new on the face of earth, and it's about doing things, thinking them through. But from the practical perspective, just refer to what successful people have done, what is it that they've done, and whether you can apply them. I don't know what other pieces of advice I could share. Some young people want to start off and they have no wealth. Well, they should start investing with whatever they own. It's better to start today than tomorrow, even if it's done virtually. And if you have more wealth and you want to go further, well, get trained. I mean, depends on how much you want to engage with the process too. And this is something that I also explained in the book. Depending on your engagement level, you would do more or less things. You can invest into active funds, passive funds. There are different levels of time, that different amount of times that you can devote to this. And I'd say to study the track record over the cycles to see how this works for them, and to gain a perspective to actually understand what the manager has done over a sufficient period of time, and also to try and understand the competitive advantage. I mean, why is it that this fund manager is doing well, and consider how this competitive advantage can be replicated. And also look at the portfolio. Look at whether the active share is similar to indexes or is it slightly different. If the portfolio is the same as indexes, or if it's very diversified, if there's 60 or 70 companies and it's the same companies as you can see in the index, perhaps it's really something that doesn't make that much sense to look at the active share for that manager. And then the costs need to be reasonable too. If costs are at 2%, maybe that's a high cost. So look at the competitors too. And to finish off, try and understand how the manager concentrates the positions and why, when they rotate and why, and try to understand the setting so that you can make your choices with a clear mind, with a cool mind. And this is a question that I always ask other colleagues when they ask me where to invest. And I always answer, what will you do if it drops by 20%? When they answer that, you can tell them to go in this or that direction. But if you're not ready for that, maybe you're not ready to invest. So you need to be patient, and you need to keep it up. And this is the end of our questions. We have heard the different answers, and if your question hasn't been one that hasn't been answered, you can reach out to us and we'll be delighted to give an answer to you. Do you want to close with any messages? No, just to say thanks everybody, and We hope that we can do more with our profitability. We haven't done that much. We need to continue to push through. Thank you very much.